it's a subterfuge. I mean, what is really disheartening is that this whole situation comes from hijacking institutions, using allegedly democratic means to push an agenda that is in which, at the end of the day, what really is in the background of all this is that he doesn't have enough majority. He does not have enough of a majority to push his agenda.
So why don't the Spanish government let them go for it then? Go and say, right, you want to do this? All right, go for it. Do what the British did, who didn't think that Sturgeon had a majority. And in the end, she didn't. So why doesn't Madrid let them go for it?
First, they have. Catalonia has voted 5 times in the last 6 years, and the separatists have never reached more than 40% majority. So they always use this, by the way, like in Scotland. You remember they lost the referendum. The next day they were calling for another one. It doesn't matter. Separatism is about victimism, and it's always going to be saying that they are not allowed to talk.
All right. So my second question, before Karen jumps in, and she's got a huge number of questions, is why not give them a bone? Give them something. Give them a bit of economic autonomy of some description. Given what the Basques have got.
Which I completely agree. And that is the solution, in my opinion. I can be wrong, but I think that is the solution. I think that companies, economic agents, people that want Catalonia to do better, I want Catalonia to do better, I want Spain to do better, know that secession is a very, very negative economic event, both for Spain and, more importantly, for Catalonia. So what I want them is to have more autonomy, not less autonomy, because everybody talks about this secession as if it was about freedom. They want to be in the European Union, they want to be within the same structures that Brussels is imposing, and therefore, it doesn't make any sense to make this about borders. It has to be about making lives better for the Catalonians.
This is a direct result of a lack of structural reform, isn't it? I mean, we keep talking about reforming Brussels, but states need reform, because if you look at Spain in particular, you've now got people searching for identity. There's no buy-in to the government, because people don't feel like they're getting something back from the state. There's been too much corruption, so people don't have trust in the elected authorities. So you have a breakdown, and this is manifesting itself in Catalonia wanting separatism. So to me, you've got a crisis unfolding for Spain overall that it needs to conquer. And Rajoy, is he the man to do it when he can't even rally enough support for his own government?
Well, separatism in Spain doesn't come from yesterday. It doesn't come because of corruption now. Separatism has been happening in Spain for a very, very long time.
And so too has corruption.
But more importantly is that this party in which Mr. Puigdemont participates in, or where he comes from, is the epitome of corruption in Catalonia. They were famous for charging 3% of every transaction that happened in Catalonia. It creates multiple depression. In the long term, it is very damaging for shareholders, and we have seen over and over and over again all over Europe and developed markets how these large corporations spin off a company, and in very, very few occasions they create value both for the parent shareholders and for the spin-off shareholders.
It's a great example, isn't it? I mean, we've talked about Bayer and Covestro quite a lot as well. Covestro is a company that is absolutely nailing at the moment, as opposed to Bayer, which is still soul-searching for the right formula of its business. And yet
Philips Lighting.
Yeah, well, I mean, Philips Lighting, I think it's a very interesting area as well. You're right, but I mean, if you've got an area which you think, as you say, LED or what have you, going forward is a great thing, it just seems crazy that in the name of splitting off because the activists want this, or they want that buyback, or they want that extra return, or want that special divvy, it just doesn't make sense in many cases.
It doesn't make any sense, because think about it. Either you spin it off completely, either you just get rid of it in the sort of ConocoPhillips way, and then because you create a case that separately managed is going to be more dynamic, is going to be more shareholder friendly or more margin expansion, that's fine. But when you keep it, there's absolutely no sense. It makes very, very little sense to me. It just creates a little bit of financial engineering.
Daniel, that music in our ear is meaning we've got 33 minutes to go to the start of trading, and the European market's tentatively pushing higher after a decent old session yesterday. Karen will talk you through the open in 33 minutes' time. Right, let's talk about oil. OPEC is set to release its monthly oil market report later today. This after WTI and Brent posted their best session in over 2 weeks during US trade. Now, CNBC and, of course, Jeff especially in Russia has spoken to a number of oil heavyweights and asked about the level of compliance within the OPEC deal.
We need a little bit of patience. It has taken us over 3 years now. Therefore, all hands must remain on deck, not only to achieve this equilibrium price through restoration of stability, but how to work jointly with our non-OPEC friends to take measures that will sustain the restored stability 2018 and beyond.
We're not going to get complacent. We're not going to celebrate anytime soon, because until we get the balances to where they belong and then continue to ensure that we have adequate supply, adequate spare capacity, and that we keep our eyes on the road as we bring the global energy markets in balance to continue to do our key role in the global economy, the job will not be done.
As a whole, we are satisfied that OPEC is complying 100%. But there are some countries that are making greater reductions in order to compensate for other countries that are underperforming. And of course, we also think that this is not entirely fair, and we are calling for each country to implement its agreements fully. But that is probably more of a matter for OPEC. In this instance, we are speaking out as a participant country to the agreement.
Let's get another view on this now. Joining us live from Zurich is Giovanni Stornovo, who is CIO, Wealth Management Research at UBS. Giovanni, thank you very much indeed for joining us today. Look, this whole exercise from OPEC and their Russian and rest of non-OPEC allies is all about getting inventories down to 5-year averages. That is the stated goal. How are they getting on?
Quite well, considering where the inventory overhang was at the beginning of the year, around 11% above the 5-year average, and as of September we are probably around 5% above this average. And it's driven by strong demand and muted supply growth.
That's good news for the producers. They're getting really down the road of where they wanted to get. So once they get to 5-year averages, and if we can extrapolate from that it might not be too much longer before they're roughly where they want to be, how do they maintain discipline? Because from Iraq to Iran to Kazakhstan and players who are not in, from Nigeria to Libya, everyone wants to produce full tilt. So how do they maintain discipline?
I guess this time the deal is historic in respect to the head of state signing off the deal. So we had already last week the Russian president meeting the Saudi king. So it's not about oil minister deciding about something, and that's the reason why compliance has been so high this time compared to historical average of around 60%. And I believe this trend is likely to continue as long as the deal remains in place.
Giovanni, how are you? Couple of things. First, $56 a barrel after hurricane season, after massive OPEC agreement, 100% compliant, $56 a barrel with regional tensions, with North Korea, everything going the way it's going. Success? Do you call this a success?
Considering that a few months ago, no one really expected we could approach $60 a barrel, and everyone was talking that the oil prices could go at 40 or even lower. Yes, that's probably a success. Also, we need to consider what would have happened to the oil price if OPEC wouldn't have come up with the deal last year. We would be much lower nowadays.
Sorry, but it's not. It's not 60, it's 56. It's a big difference. It's a huge difference, actually. And I think that the complacency that tends to happen in these events is that what has not happened will happen without the geopolitical risks. So from here to the end of the year, what is likely to happen? We don't have these disruptions. We don't have that kind of agreement. More importantly, they're talking about 100% compliance, and Russia's at 9.9 million barrels a day, and Iran is targeting 4.4 million barrels a day, and they're calling for the U.S. to curb production when the U.S. does not decide. It's not a government decision. So what is going to make oversupply, which still is there, change in the next months?
I see the oil price in the fourth quarter. When I talk about the oil price, I mean Brent in a range between $55 and $60 a barrel. And I believe the main driver for this price environment where we trade now and we should trade over the coming 3 months is that demand growth will be stronger than supply growth. And we need to remember where OPEC supply was 1 year ago. If Saudi Arabia is implementing what it has indicated the other day, that it plans to cut their exports to 7.2 million barrels per day. That's 1 million barrels per day lower than 1 year ago. And production could be also 1 million barrels per day lower than 1 year. So the supply growth will be relatively muted in the fourth quarter. And that's the reason why I think the oil price remains supported in the fourth quarter.
Giovanni, let me just bring in the US shale producers here, because OPEC has been calling for shared responsibility from other producers, namely US shale producers. That suggests shared pain as well. We know that the shale producers did go through some level of pain, but private equity has been very active in that space, cleaning up the finances of some of those producers. Do you see any chance of shale producers teaming up with OPEC around production cuts?
That's anyhow very challenging. So who should OPEC talk with? There are so many producers in the US, so that's not possible from that point of view. But also from a market perspective, it's not allowed. So the Department of Justice wouldn't be happy if they agree something with OPEC. But I guess what is completely different than what we have seen at the beginning of the year is regarding US supply growth. At the beginning of the year, there have been market participants saying there will be a wall of supply coming from the US. That hasn't happened at all. Since February, US production has grown by around 35,000 barrels per day, month on month. It's growing, but it's not growing as much as some have feared. And that's the big difference.
Well, let me just bring up Barkindo's comments then. The OPEC Secretary General effectively suggesting some extraordinary measures in 2018 would be required to rebalance the market, suggesting another layer. Given what you point out about the response from the judiciary that this is just not acceptable because effectively it would be some form of collusion from US producers, what does that mean about Barkindo's comments? Was he just simply jawboning the market, which is what we've seen in the past from OPEC?
That's part of the story, probably, so to keep the market sentiment in a positive environment. But I believe it's also related that they don't want to go from a successful strategy to the old strategy that everyone produce at maximum volume. That's something the market probably doesn't like, to see OPEC increasing production, say, by 1 million barrels per day into the second quarter of next year. So it's probably something around, we need to ensure that we don't flood the market, that we have, let's say, a taper exercise like central bank do. We only moderately increase the production. And that's something the market can afford to take.
Giovanni, we had Fatih Birol from the IEA on recently, last week actually, talking about how the Chinese are just streets ahead of everyone else on photovoltaic, on all kinds of other initiatives about electrification rather than using hydrocarbons. So let me ask you the questions. If the Chinese are slowing down their rate of growth of purchases on the demand side, where else is everyone going to sell their barrels to? Because we know that everyone in the world is looking to Asia, whether you're Russian, whether you're United States looking to export potentially, or whether you're one of the other OPEC players. You really, really want to sell to China and the emerging markets in Asia especially. Is there a demand growth question that you will have?
I don't think so. It's related to the latest revision also from the International Monetary Fund yesterday, revising up the growth for China. So the Chinese economy is doing fine. It will slow down, but oil demand will continue to grow in China. Probably there are longer-term issues, as you mentioned, about electric vehicle cars, but that's not something affecting the demand in the near term. Another point to consider is when it comes to strategic purchases of China, here probably higher prices might slow down the demand for strategic purposes.
Excellent. Giovanni, thank you very much indeed for your time today. Giovanni Stornovo, who is a CIO Wealth Management Research at UBS. Did you want to just come in very quickly on this story? I think you seem slightly sceptical that the efforts have achieved their goal. And yet Giovanni was saying that we've gone from 11% over inventories 5-year levels to only 5%.
Well, inventories are still at the high levels of the average. of 5 years. But more importantly, I think that the bulls of the oil market are missing the elephant in the room, which is efficiency and technology. And it takes away every year, no matter what they say, it takes away estimates of growth of demand by the region of around 500,000 to 600,000 barrels a day of expectations of the beginning of the year to the end of the year. So I think that the problem that we're finding here is, look, it's okay. The OPEC has achieved to put a floor on oil prices. That's what they've done. But the big problem that continues to happen is that the level of investment that had been taken in the last decade created an overcapacity that is simply impossible to offset with a Chinese economy that is moving to a different stage, which is moving to a different stage that is less about a massive use of commodities and more into the services businesses.
So you're saying the bulls are missing the elephant in the room, but not the cat amongst the pigeons, and they're all being lemming-like and going over the cliff?
Pretty much so.
OK, let's get some more animals into this as well. Right, Spanish bank shares seen up 4% after Catalonia leader stopped short of declaring formal independence. So say traders today. Right, OK, coming up on the show, what % of American households own at least one Apple product? I don't know the answer. Should we guess? Do you know the answer? If you know the 60%, I'm going. What do you reckon?
I would say 60, 65.
I think maybe 70.
Look at you, staying quite close to us, but slightly bigger. OK.
Well, it is an American company, right? They might be losing appetite, but they would have some old devices, you'd think, right?
I've just seen the answer. We'll discuss and reveal after the break. Thanks, Steve. It's great. Look, I know we've got to move on. What do you think? What do you reckon of that? You didn't think people... It's Arjun, by the way.
Hi.
Hi. You've got to do that for the next 6 years of your career at CNBC now.
Would you say why bother with a camera if only 12% are using the camera? Why bother with the camera technology?
Feature that everyone, all the manufacturers talk about so often, the camera.
Stop upgrading it, stop spending the money, spend the money
Quite
elsewhere.
surprised at that.
I think they're lying. I think
And emails? I thought your generation didn't even know what an email was.
No idea. We send letters, Steve.
Letters, yeah. In your copper plate handwriting. Hola is not just the greeting that we do with Arjun, it's also the name of the Indian ride-hailing service. It's raised $1.1 billion from investors as it continues its fight against Uber. Included amongst the investors was China's Tencent and Japan's SoftBank. Hola has also announced it is in advanced talks to raise another $1 billion from different investors. Hola intends to use the money to invest in artificial intelligence technology. I just can't help saying hola. It's one of those words which has got joy in it, isn't it? Don't you think? There are certain words. Unlike Brexit. Hola!
And then despite the name, this is an Indian startup.
Right.
And
Hola's not an Indian word, is it?
It's not an Indian word.
No, OK.
But it's a ride-hailing. It's Uber's biggest rival in India. It's a fierce competitive
Do they
Indian
pay national
rival.
insurance?
Do they?
Oh, no, that's a British debate with Uber, isn't it?
Yeah. Well, so this is the ride-hailing service over in India. It's Uber's biggest rival out there. It's raised $1.1 billion from SoftBank and Tencent, and one source tells me that this values the company at $7 billion now.
What have they got that Uber hasn't? I mean, what's the differentiation between all these companies?
So what Ola's been doing in the Indian market is trying to localize far quicker than Uber has. So it's introduced things like hailing rickshaws, hailing bikes and motorbikes. And so that's where it's trying to differentiate, and it's got a deeper penetration in smaller cities than Uber has. But at the same time, when you're fighting Uber, this is why they required this large amount of money to go toe-to-toe with them in the deeper markets. And so it's a continued battle.
To the question of what they got, a SoftBank board member, perhaps? Is that the question? I mean, Uber's been fighting whether to take one or not.
Yeah, and the interesting thing is, SoftBank is, of course, also potentially going to invest in Uber. Tencent is already invested in other ride-hailing services in other countries. SoftBank has invested in Grab in Singapore, for example, Tencent in Gojek in Indonesia. Now, these are all rival services that are local players. So these investors are trying to essentially invest in what they believe is the next generation of transport.
Finger in every pie, just in case. We always ask the question, how did you know that this was going to be a success? And most of those investors say, oh, well, I invested in a whole bunch of them. I thought this had potential, but, you know, it really is about diversification strategy. Yeah. This is the SoftBank strategy, isn't it? It's about diversification.
SoftBank strategy is insane. It's just throw money at the biggest startups in the world. That's it. And hopefully a few of them stick. And that's really the strategy here, is they feel that they are investigating begin what is the next generation of each industry in which they are investing.
The question I have is whether this is now going to be an evolution in ride-hailing services, because Uber was well and truly the first adopter, first mover advantage, well and truly out in front, but it's had so many execution issues. Yeah. You've got to wonder whether it survives or whether it's surpassed down the track by a rival service that also has critical mass, which they've achieved through a market perhaps like India.
Yeah, and this is actually an interesting time for Ola to have raised the funds. Uber is in a little bit of trouble at the moment. New CEO, boardroom issues. So it's a good time to raise and to start, expanding their presence in India. It seems that a source at the company was saying actually what they're focusing on is more the Indian market and scaling there rather than internationalizing. Uber, on the other hand, is saying actually we're going to be in every market. And that's where sometimes the danger is if a local rival with better expertise of the market, deeper penetration in smaller cities, particularly in a country like India, can get ahead. That's where Uber will begin to struggle, and that's what we saw in China as well.
Though, for an international traveller, when you arrive somewhere and you don't know what the service is, it's like, oh, do they have Halo? Do they have Uber? My Taxi? What are the options here? It's becoming more and more confusing, and some of the companies are changing names as well. It's not making it sort of a universal service that you can use in individual markets.
Yeah.
Dan, any thoughts on
I think
this?
that is the difference. I think that the difference is that none of these brands have been able to establish themselves as the easy solution for somebody that doesn't know the area or the market. It's not the Google that you have when you're just looking for something on the internet. So the problem is precisely that, is that as an established brand, it is very easy to break your market share, and it's very easy also to make it difficult for them to grow to a level at which they become the established player. And I think that is the risk, because the problem that we're seeing with all these different options is that so far none of them is really a viable business. So far they're just startups of a business. When that's what the next step, and we obviously, it's going to be very challenging to understand. But what I believe is that you need to get to a level in which the brand becomes so popular, in which you would be having that first option advantage from consumers.
Dan, thank you for that. And I don't believe you've been writing about this for the web as well. You can check out that story at cnbc.com. And just a thought to leave you with, down the gutter, scientists in Switzerland estimate that 43 kilograms of gold worth around $1.8 billion passes through the country's wastewater every year. The research showed that in some instances, the concentration of gold in sludge was high enough for recovery to be worthwhile. The report also found that around 3,000 kilograms of silver, worth about $1.7 billion, is going to waste every year. It's a great story. So what do you get out of sifter and you go and
It does beg the question, why did scientists start looking into this as well?
I think
we've got a sneaky feeling. I'm just doing my PhD at Basel, and I've just got a sneaky feeling if I investigate, there's going to be a load of gold down the pan. Literally.
How did they get to the figure?
Anyway, the IBEX is called at 1.4%. Exactly how they get it. 1.4% higher. The IBEX is called. And if you're in Zurich now, don't do it. OK, we'll be back after a short break. Excellent. Thank you very much indeed for that. Well, let's introduce Stephen Macklow-Smith, who is Head of European Equity Strategy at JP Morgan Asset Management, and, of course, Dan Lacalle, who is with us from Trésis Gestion. Right. Is it French, the company?
No, it's Spanish.
Oh. Isn't gestion a French word?
No, it's you
use it both sides of the Pyrenees, can you?
No, but it is used in the same context.
Right, okay. Hi, Stephen.
Morning.
You are, let's set the scene. You've been bullish European equities for quite a while.
Yeah.
And that's paying dividends for you as well. So congratulations on that.
They are paying dividends.
Yes, they're paying dividends and they're going up. Yes, yeah. Very good. But this year, however, flows have returned to European equities. Election risk did not materialise as part of a longer sentence. But the election risk materialising bit is what I wanted to come to you. Because we see ourselves with this Catalonia issue at the moment. We see ourselves with a situation in Germany where Frau Merkel absolutely has won again, but with perhaps challenges within the Bundestag, with the AfD getting in as well. Yeah. And then we see reports beginning to come out that Macron and Merkel might not be on the same page in terms of their blueprint for Europe. So whilst unambiguously, things like the Dutch election, the French election, went the way of the mainstream or how the centrists would like it, there don't seem to be risks politically on the horizon still about the cohesion within Europe.
Yes. So one of the taglines that I was using at our senior investor meeting in New York 10 days ago was to say, Europe, it's never as bad as you fear, it's never quite as good as you hope. So you might hope that political risk has now completely receded, and of course it hasn't, because there is a populist backlash in many countries, mainly as a result of what happened in the financial crisis, and partly due to question marks over the handling of the immigration crisis. So, populism is not going to go away, but the key point to understand is that populism is not managing to wrest control away from the centre ground, and that's the analysis that we published at the back end of last year, saying if you looked at the elections coming this year, it was supremely unlikely that populists would win through, and that's what we've seen.
I love the line, never quite as bad as you feared and never quite as good as you hoped. And on that latter line of that as well, the market seems to think that it is pretty good as well. The market's, I wouldn't say going gangbusters, but it's going pretty well to the upside as well. So do you think that the equity markets have run ahead of themselves compared with the reality?
Not for the moment, no, because with a recovery in nominal GDP happening both this year and next, and operating leverage at companies, we're expecting earnings to grow. So prices moved ahead of earnings. If you look at valuation on a price to historic earnings basis, it looks testing. But on a price to current year basis, it's less testing. On a price to forward year basis, it's in line with the average. And given that European earnings were becalmed for 6 or 7 years, mainly because of issues and structural problems in certain sectors like banks and basic resources and energy in the back end of that, nevertheless, with a background of global growth which is now looking synchronized across the world for the first time in many years, that's a pretty good environment in which to make money for European companies which are very, very broadly based. And just one last point, whether Macron agrees with Merkel or not about the future of Europe has very little relevance to the stock price of European companies.
Okay.
I actually I'm a little bit more concerned about European equities. The concern I have is that the market is taking a recovery as an excuse for multiple expansion based on an estimate of forward earnings that, if we look at the last 10 years of estimates from consensus, they've been consistently going down every year, every January it's plus 12% more or less, and every December it's plus 0. So it is a continent of very low growth in earnings and very low growth in margins. So let's see what has driven this multiple expansion is, first, banks with still 900 billion of non-performing loans have stopped doing provisions. Very dangerous to me, at least as an investor, as a long-term investor. Second, you have telecoms, industrials, utilities, all of them improving their margins from earnings abroad, not from the European Union, which is fine. But that is a recovery of something that has been acquired and bought at extremely expensive multiples in the M&A frenzy. So the challenge that I find is, why can I believe in multiple expansion when I don't have, like I have in the US, the guarantee of buybacks and dividends that US corporates give to me, because Europeans don't do that. Actually, they increase the share count whenever they can instead of reducing it.
I absolutely agree with you that if this was all about multiple expansion, it would be not necessarily particularly soundly based, but it isn't. Price is looking forward to expanding earnings growth. So you're conflating two arguments there, one of which is the multiple is expanding, the second of which is earnings are not going to grow. And we know that earnings haven't grown for the last 6 or 7 years, but mainly for structural reasons associated with particular sectors. But with the recovery in nominal GDP growth around the world, not just in Europe, then the background for operating leverage to kick in for these companies looks fairly encouraging.
That's the key thing that I think we can disagree, because it's all about the future, obviously, and estimates. But the way that I look at it when I invest is, okay, what do I need to believe in? The first thing that I need to believe in is in companies giving a little bit of guidance. I mean, European companies, atrocious at guidance, not atrocious, even worse. They've been hugely wrong before the crisis. In the third quarter of 2007, they all thought that the economy was doing great. And
I don't think that was confined to European companies.
I think that if you look at the Euro Stoxx 600, you would gather a tremendous majority. But in any case, the problem that I find is, okay, it might be a contentious issue whether we believe in earnings growth for next year. But what is not happening at all is the improvement in operating margins. Almost 60% of the Euro Stoxx 600 makes returns below its cost of capital. So it becomes almost like the Chinese market, which is a leverage on inflation. But inflation expectations are coming down, and that's my problem with European equities going forward. I agree. I agree with the recovery call. The recovery call is fine. It's a better money supply, by the way. No question about it. But I need to see more than hope, and obviously more than a consensus that has been consistently wrong for 10 years to believe in those earnings estimates.
It's interesting that you bring out the subject of consensus, because of course if you look at consensus numbers in any market, not just Europe, it's always wrong at the start of the year. That pattern of continual downgrades is repeated in America, the UK, and pretty much anywhere you look around the world. And the reason is that analysts mostly base their earnings expectations on an expectation that returns will mean revert, and if they don't, then the number is wrong, and
Right.
they have to adjust it. But it's interesting to me that this year earnings downgrades for Europe have been very, very marginal, if anything at all, and next year the number still hasn't moved. So I feel relaxed about that.
You mentioned structural changes, which is a tangible for investors.
Yes.
Give us an example of that.
Structural change.
Yes.
If we think on the political level, the reaction to my reading in Europe to a crisis is always to increase the level of integration. And you can see that on the monetary side. So, the reaction to the failure of the snake in the European monetary system was the ERM, and when that failed, it was the failure of the ERM in 1992 that really provided the impulse to launch the euro. And if you think about the reaction to the financial crisis, the reaction was the banking union and the stress test and installing the ECB as top regulator.
So this impacts the banks, and the structural changes that you cited is dominant for the banking sector. But what about elsewhere? Do the structural issues that you've been talking about, do they impact companies more broadly speaking?
Well, there's an attempt to address the cost of labour within Europe, which it varies from country to country, but it has been, broadly speaking, too high. There's an attempt to address the cost of pensions in Europe. And the way that European reform works is not like a sort of Thatcherite revolution where you get sort of a big bang moment. You just get what we would characterize as salami slicing, to use a Mediterranean or Southern European analogy, where you just simply remove entitlements incrementally over a long period at a relatively slow pace, precisely in order to avoid a populist backlash. And those reforms to pensions have taken place in Italy and France and Greece.
To the point where you can tally up a number and say, well, this is beneficial to a company. Because I think that's the hard part when it's happening on an incremental basis and it's sort of mood music almost shifting. It's a little bit hard to then look at a company and say directly, I see an improvement on your numbers, on your profitability, to the point where I'm willing to invest in it based on these incremental changes.
Well, if you think about the way in which companies manage their cost base, one of the characteristics of the last 6 or 7 years is that although earnings haven't grown, profitability has been defended by companies extremely astutely. And that's not just a matter of benefiting from structural reform within economies, because a lot of the structural reform affects the public sector rather than the private sector. And that's an issue in most countries, including the United Kingdom.
Can I make the assumption then that if Emmanuel Macron were to deliver fundamental reforms to the labour market, that there would be an immediate implication for the French market, an immediate re-rating based on what you're saying?
I think it's going too far. He will have he's proposed reforms. There is opposition to those reforms. He will get some of those reforms through, and some of them will fall by the wayside. There will be no big bang moment, but there will be incremental improvement, and there will be incremental improvement to fiscal solvency for European governments.
I think that you're right in that. I think that the challenge is that the pace is overrode by and completely offset by the aging of population and the challenges of fiscal consolidation as well. So it is the European Union is nowhere close to being at a decent pace in terms of
the European Union is not America, and it's not the United Kingdom.
Of course
it
not.
Never will be.
That is why it deserves a discount.
and it precisely commands that discount at the moment. But the dynamics are different. I'm interested as an investor in making money slowly. I mean, I'm interested in getting rich slowly rather than quickly. I'm not really interested in big bang revolutions which kind of transform the landscape. Much more interested in trying to gauge a slow but steady improvement and a movement which is, the direction of travel is now very well established.
So shall we talk about Bitcoin next then? On that note, let's squeeze in a quick break. Our guest staying with us. Coming up on the show, Walmart saves $27 million simply by changing its plastic bags and shortening its receipts.
Let's talk to Stephen and Daniel about some of the individual sectors as well. And I know, Stephen, there's a theme going through our conversation off air about paper as well. But actually, maybe we would revisit that, because you think there's a metaphor, potentially, for what the Scandinavian paper producers have done compared with what the broader commodity space is doing as well. Because the commodity spaces, you hate them, don't you? You think they invest too much at the top of the cycle and they sieve too much at the bottom of the cycle. So that's kind of your view. But you think there might be a model from the Scandinavian pulp manufacturers and forestry companies that actually could be a better model for the rest of the sector?
Well, I think it's all about corporate behaviour. So, I mean, saying that basic resources is just a bad sector, of course that's true at a sector level, but individually within basic resources you find very, very good investment. So if we think about BASF, for instance, which optimised its portfolio businesses over a period of years and years and years, the total return relative to the stocks was about 17.5%. I mean, that is a proper growth investment, but it's a chemical company with an enormous amount of part in Ludwigshafen. And, if you apply that principle to companies that are optimizing cost, optimizing balance sheets, and optimizing businesses, so getting into businesses where there's actually some kind of to use Buffett's term, a moat to protect the return and getting away from the really commoditized businesses, then yes, it's possible to make money in the sector. So on paper stocks, if we think about what was going on there 20 years ago, 20, 30 years ago, it was a classic case of, good times in the cycle you overinvest and then that crashes prices when demand collapses. And that's precisely what they haven't been doing for the last 10 or 15 years. There's a much greater level of consolidation in the sector and a much greater willingness to try and defend returns where they can get it. Plus they have the secular growth story from packaging and e-commerce.
It's extraordinary. 21st century, here we are, 2017, we weren't supposed to be using paper so much anymore, and yet it's a boom business. Well, Daniel, do you accept the metaphor?
I think it makes sense what you're saying, because it's first acknowledging that you're in an ex-growth sector, and therefore making growth of the business the strategy, not growth of demand and tightness of supply and praying for OPEC to cut. I think that the difference, you were mentioning chemicals, is precisely that. Chemicals, tobacco are similar sectors in the sense that they acknowledge that they are ex-growth sectors and therefore they manage the business. The problem with...
Is tobacco ex-growth now?
Tobacco is ex-growth.
Globally? I mean, I know in developed Western markets it is.
Yeah, globally I'm saying. Obviously in emerging markets it is not, but in globally it is an ex-growth sector, and it actually behaves like an ex-growth sector. That's why I like some of the tobacco companies.
Actually, talking of tobacco, do you know how much a pack of cigarettes... One of our producers, producers said how much a pack of cigarettes in euros is now in Ireland. I think, was it...
But that's all taxes. It's horrible.
12 euros.
Yeah,
I mean, I've no idea.
Crazy, yes.
That's a lot of money, isn't it, if you've got a 40-a-day habit?
We're heading towards the €1 cigarette.
Well, that's like...
So if you're on 40 a day and you get 20... That's, what, 24 euros... a day,
exactly,
on cigarettes.
And think about what you're paying to the taxman. I think
no wonder it's going above 60%.
It's above more than 60%. And in the case of oil, it's pretty much the same of gasoline.
Yeah, of course.
But the thing, I think that the sectors that you have to look at, like you were mentioning, are the ones that acknowledge which global environment they're in, and not try to sort of ignore or pray that it's going to change, that the tide is going to change, and that they manage what they can manage.
Very short time left as well. Can we have a quick look at banks as well? You mentioned the 900 billion euros of non-performing loans. You talked about a bit of, well, we talked generally about the recovery in the banking sector as well. Do you have concerns that a few bad apples could still bring down what is a great recovery story for many companies in that sector?
Well, I always have concerns. I'm a fund manager, so I'm paid to worry as well as to truffle around.
Do you worry a lot?
Always. The figure that Daniel mentioned of 900 billion euros of non-performing loans, I imagine that's a gross figure, so it's not...
No, it's net. That is net.
So if we think about that, for instance, for Italy, if we think about it as an object lesson in how to deal with non-performing loans in the banking sector, or how not to deal with non-performing loans for an extended period of time, the fact that the sort of Gordian knot on non-performing loans in Italy has now been cut, and you can narrow the gap between the price at which they're marked on bank balance sheets and the price at which they trade in the secondary market, that has longer-term benefits to the Italian banking system, twofold mainly. Firstly, you can increase the flow of credit because banks are no longer worrying about simply managing their stock of non-performing loans, they're actually managing themselves as banks. And secondly, you can unleash more consolidation in the sector. So we would expect to see more M&A in Italian banks. So, you know, we're concerned. But I think that if you looked at the heritage of the financial crisis and the banking union, what you're seeing is banks moving to a utility type model where when they spin off excess capital, they return it to shareholders, and that's what we want.
Stephen, we're going to leave it there. Lovely to see you. Thank you very much, Steve, for covering so many sectors, from paper to banks and what have you. Stephen McAlow-Smith, Head of European Equity Strategy, JP Morgan Asset Management. Daniel, you stay with us. Coming up on the show.
Ahead, the Spanish government is meeting today to decide its response to the crisis in Catalonia. We'll be live from Madrid and Barcelona right after the break.
Excellent, Jemana. Thank you very much indeed for that. And thank you, Willem, in Barcelona. Daniel, we would never ask the Scottish government, are you better at handling money than Westminster? We would just assume that on a regional basis, Edinburgh probably knows what to do best. We wouldn't ask California whether they're better at spending it than Washington. California would presumably be better at spending its own money rather than having a federal oversight. So why do we actually think that the current deal between Catalonia and Madrid is acceptable?
Well, I think that first, no comparison, is that the level of autonomy that the regional government of Catalonia has on healthcare, education, on infrastructure, on all aspects of money management is unequaled to any of those regions. No question. I mean, the level of autonomy is much higher. But in any case, it can be higher, and it can be agreed. And obviously, where we need to go in Europe is to a system that, if the European Union is going to be successful, it needs to have levels of management of money that are closer to the voter. That is absolutely fine. That doesn't mean implementing.
Whoa.
That doesn't mean implementing borders.
Hold
Absolutely,
your horses.
absolutely.
Hold
yes.
your horses there. Hang on, didn't Macron want a European finance minister? And
No,
a
that
European...
is different.
Hang
No.
Hang on. It's not different, because you just said for the European Union project to be successful,
yes,
you need something that's closer to the voter.
Sure.
Surely, if you have a pan-European finance ministry and an unelected pan-European finance minister, that is further away from the people.
No. I mean, let's
Do you
start.
agree with me or you don't?
Do I agree with Macron? I think that we have established that in this program numerous times that I don't.
We should have pan-European authorities.
Let me put it this very, very clearly, and I've written about it many times.
I know you
I
have.
am completely against a pan-European finance minister and an European monetary fund. Completely against it.
Okay, so
and
Macron's
Eurobonds. Why? Because they are perverse incentives. I completely disagree with it. However, on the point of Catalonia, which is the point, is the solution is not to put borders. The solution is to improve what is already a good system of autonomy. And what is happening here is that they are using the subterfuge of allegedly democratic instruments to implement a secession that only serves the interest of the bureaucrats. It has absolutely nothing to do with freedom, because they don't want to get out of the European Union. The Brexiters, everybody that's the libertarians, please, the separatists in Catalonia don't want to leave the European Union. They want to be more interventionist than the European Union is itself. If you look at every single aspect of their independence declarations. So the point here is about how do we get things to improve for the Catalan people, and obviously for Spain, and obviously for the European Union. And that has to be through a better management.
Do you think everyone's forgotten the crisis already? I mean, it's been, what, a decade? But, when it came around and when countries needed help, who did they turn to? They turned to Brussels, and they turned to bailout funds. So effectively, if you're going to have a backstop for Europe, doesn't there need to be more integration for the next crisis? And when you talk about a finance minister, it's not a finance minister for Europe who's taking all the money from all these countries and say, I get to manage all the money. That's not what they're talking about. They're talking about attention to detail on budgets, having a concerted strategy forward for these countries, and not having too much fragmentation.
An extra level of bureaucrats, an extra level of finance ministry and sub-ministers.
But
you're saying they're not taking... But this is perhaps the biggest problem that British...
Nominate a department in Brussels where you could take some money from.
I think you're right on paper, and you're right on execution. Is that the problem of the European Union is precisely that. Is that what you have just said can be solved without the need of a super minister or of a monetary fund. It can be done with a better management of credit, at the end of the day, it's all about being responsible. Credit responsibility.
We've got to move on because we've got another guest coming up. So coming up on the show, Egypt is attempting to attract foreign investment while it battles soaring inflation and internal political strife. We'll be discussing the challenges the country faces with Her Excellency Dr. Sahar Nasser, Egypt's investment minister, after this break.
And when you look at those reforms, obviously it's you mentioned it has to be a very comprehensive package with lots of things put together. But for you, what is the key one? If you had to single out one that would make the difference in a country that has improved in terms of ease of doing business, that has improved in terms of access to international direct finance, what is the key point that was going to tip the scales to get all that investment that is needed into the country?
Obviously, as the Minister of Investment and International Cooperation, I think a lot of more private sector participation. So we're working full force at the Ministerial Economic Committee to make sure that the business environment is conducive, that Egypt is open for business. We're very much keen on a more diversified economy, not just tourism, but also the industrial, the technology, the agricultural development. Egypt has a very strategic location. It's a huge market, young population, resource rich. I think it's very important to unleash all these potentials. So I tend to think of how can I make the business environment more conducive? What is the legislative reforms and the institutional reforms it takes to attract investment back, whether the domestic investment, regional, but also the global ones.
Dr. Nasser, one look at the map and shows that how close you are to a lot of regional instability. Obviously, there have been many domestic issues, and one of them was surrounding the Muslim Brotherhood. And actually, the Muslim Brotherhood is one of the reasons cited why Saudi, Egypt, and other nations actually have ratcheted up diplomatic pressure on Qatar, for instance. So my question to you is, do you fear that regional instability will once again scupper a growth plan for Egypt?
Interestingly, I look at it a bit from a different perspective. I do acknowledge the current situation in the region, reflecting on many neighboring economies, and that in fact is helping Egypt attract more business and more investments, because Egypt is seen now as a regional hub in Africa. It's the global hub for the whole continent. So in fact, this is helping us attract more investment from the Arab countries, but also from the regional countries. And I also see that Egypt's economic stability and recovery is very critical and is a prerequisite for the whole region when I look at the MENA region overall.
Okay. Well, that's a good note to leave it on. Also, I noticed the tourism stats. I literally didn't know what the figures were, but quite extraordinary rebound from the lows, of course. So I think jumped 170% the tourism revenues in the first 7 months of the year, but obviously a long way from where you want them to be, but on the right track. So, Dr. Nasser, thank you very much indeed for joining us. It's very nice you could spend your time and enjoy your trip to Washington. It'll be very interesting to see how you get on with at the World Bank meetings.
Thank you very much. It's a pleasure to be here on your program.
Her Excellency Dr. Sahar Nasser, Minister of Investment and International Cooperation in Egypt. We've got a bit more time.
Bitcoin. Former Fortress hedge fund manager Michael Novogratz says he can see Bitcoin heading over $10,000 in 6 to 10 months. Speaking to CNBC, he likened the cryptocurrency to digital gold and said he can see the herd coming. I mean, perhaps that should be a wake-up call if there are such bullish views, effectively more than doubling from here. Doesn't it tell you there's something wrong with Bitcoin?
I mean, what is the issue with Bitcoin? The issue with Bitcoin is that as it gets more and more popular, it becomes more and more dangerous for central banks and for investment banks. We have already seen.
Why? Not because it provides more liquidity, because it gets bigger and better.
Because at the end of the day, Bitcoin and all cryptocurrencies end up being a threat to the monopoly of creating money. And obviously, that gets many people, very powerful people, very nervous. So therefore, you have to constantly be looking at its market share relative to other currencies and relative to other means of payment. And that is, my opinion, is what gets all this volatility in the market. If you actually see what's happening, every time that there's news about a government or a central bank taking an action one way or the other, is what actually drives the price of Bitcoin, while at the same time the likelihood of more monetary repression, more monetary stimulus, more printing money from central banks drives investors closer to these reserves of value. So it is not yet digital gold, and it's questionable whether it's a bubble or not.
Stunningly volatile as well, trying to do a transaction on such a volatile product. Thank you. Exactly. Lovely to see you. Lovely couple of hours. Daniel Lacalle. Excellent. Thank you. Pleasure for us as well. Guest host tomorrow is Paul Donovan, Global Economist and Managing Director at UBS Wealth Management. From Karen and myself and the magnificent team that puts together Squawk Box, goodbye.